So let's start with the illusion of knowledge. For this memo, you discussed macro forecasting, and for many years you've expressed why you're not so interested in macro forecasts. So why is it so challenging for somebody to create a helpful macro forecast?
First of all, when you say for many years, the first memo was written in 1990. It was entitled The Route to Performance. The third memo was, I think, in 92, as I recall, and the title was The Value of Predictions. So it's a recurring theme, nothing new. The title of the memo, The Illusion of Knowledge, comes from the historian Daniel Boorstin, who said that the enemy of knowledge is not ignorance, it's the illusion of knowledge. It's the belief that people know that keeps them from exploration, which ends in knowledge. And maybe it's, I guess Mark Twain said it the same way, but a little more colloquially. He said, it ain't what you don't know that gets you into trouble, it's what you know for certain that just ain't true. When I was a kid, starting out at Citibank in the 70s, we used to talk about a lot about econometrics, which is something you don't hear much about anymore. But econometrics is the construction of a computer model which simulates the economy. All you have to do is provide the appropriate inputs, turn the crank, and you get a macro forecast. But how the hell could anybody build a model of an economy? There are billions of people in the world creating the economy. Thousands, maybe millions of business entities, government entities. And how can you model their behavior without extremely simplifying assumptions which cripple the process? How can you model not only the rational decisions they're going to make about money, but how about their emotions and their swings of psychology? And what do you do about randomness and luck and chance and exogenous influences and weather and all these things? When I was in school, we used to talk about GI-GO, garbage in, garbage out. You make simplifying assumptions that are flawed, you can't possibly have valid output. That's number one. Number two, people have biases. And our expectations, our pronouncements about the future are usually very, very much clouded by our biases. The greatest one of which is confirmation bias. We hold a view about what the future holds. We read something that agrees. We say, aha, I'm right. We read something that disagrees. We throw it out, disregard it. And I mentioned in the memo that I read a book last summer called Mistakes Were Made But Not By Me. And it's a very good book, Carol Tavris, and it's on the subject of self-delusion. And people receive information, and that's how they dispose of it. And we have this thing called cognitive dissonance, which permits us to live with or deal with views that go against our own. And I think that some of the greatest practitioners of cognitive dissonance are the forecasters. Again, early in my career, I heard the saying that an economist is like a portfolio manager who never marks to market. Cyrus was talking about the great performance at Brookfield in private equity, 27% gross return over the whole life. Can you imagine if an economist went in for business and didn't give a track record? How do you get hired? Well, they still do, the answer is. You couldn't get hired without your track record. Economists can. One of the things I say in there is that you look at the Fed. The Fed, I think, has between 200 and 400 PhD economists on the payroll. Not only can they not predict the economy, and by the way, they kind of lost it on transitory, but they can't even predict their own actions. If you read about what the Fed's going to do next year, they're usually wrong. Perhaps John Kenneth Galbraith said it best. He said we have two kinds of forecasters, the ones who don't know and the ones who don't know they don't know.
So Howard, we've got a lot of investors here, some relying on economic forecasts, I assume some not, but how should they go about their decision making?
One of the most insightful questions that I get is, you make investment decisions with regard to companies and properties based on forecasts of earnings, primarily. You know, there's a lot else, but it's subsumed under earnings, cash flow, and so forth. Don't you need a macro forecast to be able to predict earnings for a company? And I say, aha, that's it. You got me. Because you do. We have to make forecasts of earnings for companies, but we can't rely on macro forecasts. It's a great challenge. The answer is, in my opinion, that we make what I call neutral forecasts with regard to the macro, which is, essentially, we predict that the macro will be like it always has been on average. I know that's probably wrong, but I don't think I can improve upon it. The US economy's grown at a little under 2% a year for a long time now. I can predict 3 or I can predict 1. I'm probably wrong. It's probably going to be 2. Now, if I predict 3 and I'm right, I'm going to make more money than other people. If I predict 1 and I'm right, I'm going to make more money than other people. But most of the time it's going to be 2, and the predictions of 1 and 3 are going to be fruitless. So we make a neutral assumption. This is especially important, I think, if you look at a company or a property or an asset where the decision to buy it would have to be predicated on a non-neutral forecast. Well, now you've bet your outcome on whether that non-neutral forecast is right. And we don't want to do that. We don't bet on forecasts. Oaktree runs according to an investment philosophy which has 6 tenets, one of which is that our decisions are not predicated on macro forecasts. I guess one way to sum it up is, where are all the rich macro forecasters? You know, we have people who are famous for doing very good investing, from Peter Lynch to Warren Buffett, and not only did they not get famous from macro forecasts, but they mostly rail against macro forecasts. And we don't have that many people who got famous or rich from macro forecasting.
Howard, let's move on to the next memo, what really matters. And there are 2 themes here that I think it would be really insightful for people to hear from you on. One, you talked about several things that shouldn't matter for investors, in particular short-term events. Right. I'd like you to touch on that. And then you also talked about the perils of short-term trading compared to owning I think what you said is owning a stake in a business, effectively. But could you touch on those concepts, please?
First of all, before I do, let me just mention that Cyrus has referred to these memos. Anybody can get them. They're all on the internet at oaktreecapital.com under the heading of Insights, going back to the beginning. And the price is right. They're free. So I hope you'll look. In particular, I hope you'll look at what really matters, because I think it was one of the better ones and one of the more important ones, and it's one that I got almost no reaction to, which happens a long time. By the way, from 1990 to 2000, for those 10 years, I never had one response. Not only did nobody ever say, that was great, which is what we live for, nobody ever said, I got it. And so one of the great mysteries is how I kept doing it. But anyway, we had a conference in London on June 21st of last year for our European and Middle Eastern clients. And I kicked it off with the discussion of the environment and then took questions. And then after lunch, I got back up and I said, and unscheduled, and I said, you know what, I'm disappointed in the conversation of this morning, because the only questions I got were, what will inflation be? How high will the Fed raise rates to reduce inflation? will it produce a recession? When, how bad, and how long? So inflation, rates, recession. These are not the things that matter. First of all, we can't know much about these things. Secondly, if we were going to do anything about, if we formed views, we probably wouldn't do much about it. Because I've seen a lot of people discuss it, and they spend a lot of time discussing the macro forecast, but they don't make big changes in response to their conclusions, probably because they don't really believe what they just agreed on. But, these are not the things that matter. And what I said was, what we try to do is we try to invest in companies that will become more valuable over time, and debt instruments where the issuer will pay the interest and principal as scheduled. These are the things that matter.
Fundamentals.
Fundamentals. And, I describe in there around 2016, or late 15, 16, when the Fed started talking about raising rates. I believe that they kept rates way too low, way too long. I went through a long period of time, and the only question I got was, when will the Fed start raising rates? And I think I say in the memo, what does it matter? If I say March, what will you do? If I say, no, not March, May, what will you do different? And it goes back to the illusion of knowledge. And by the way, one of the quotes in that memo, somebody said, if people understood how uncertain the world is, they wouldn't be able to get out of bed in the morning. And so they cloaked themselves in forecasts to make the environment tolerable. And so, in early 2016, when will the Fed start raising rates seemed like an obvious question that one would like to have an answer to. But it doesn't deal with the question of, is it possible to obtain an answer to that question? And what would you do if you had the answer? Warren Buffett once said to me, as he said many times, that for a piece of information to be desirable, it has to satisfy two criteria. It has to be important, and the macro is extremely important. In fact, in the last 20, 25 years, it feels to me like it's the only thing people care about anymore. But it also has to be knowable. And I believe that the macro is not knowable in the sense that to be superior investors, all of us have to have an advantage, what I call a knowledge advantage. We have to know something better than somebody else, or clearly our investment performance will be average. But I don't think it's possible to know more than others about the macro. And consequently, I don't think that trading, which is in response to expectations regarding short-term events, I don't think it can be successful. And so I start the memo by talking about 5 things that I think don't matter. Short-term events, short-term trading, short-term performance, hyperactivity, and volatility. And, volatility, first of all, most people have subscribed to the view that volatility is risk. I don't think so. I think that the important risk is, the 2 most important risks are, number one, the risk of permanent impairment of capital, or the risk of not taking enough risk and underperforming. But, we care so much about volatility, and of course, a lot of performance is evaluated based on the Sharpe ratio, which is essentially the relationship between return and volatility. But why? And Buffett says, I'd rather have a lumpy 15 than a smooth 12. And I say in the memo, if you'd rather have a smooth 12 than a lumpy 15, you got to think about why. Is it for financial reasons, or is it for psychological reasons, emotional reasons? But I think that these are the things that shouldn't matter, but I think that these are the things that investment committees in particular spend the vast majority of their time discussing.
And Howard, why do you think, it seems to me there's enormous focus on the short term.
Yeah.
Especially for, I'm going to say, public stock investors, anybody buying a security. Why is that? Look, most of what we do at Brookfield is private equity of some sort or another, and we own things for a long time.
Yeah.
So I don't understand the short-term thinking. What's driving that?
A great question spanning those two memos is what you just asked. Why so much time on what doesn't matter? And why do you spend your time trying to develop a macro framework? Maybe if more people spent their time thinking about whether a macro framework can be helpful, they would change their behavior. I think most people think you have to. Most people think it's their job. Most people think it would be unprofessional or irresponsible to not hypothesize about the rate of growth in the economy and the level of inflation and the outlook for rates and currencies and commodity prices and that kind of thing. And they consider these things important, but they don't grapple with the question of whether they're knowable. And so, at Oaktree, what I say is we ignore the micro, which is unknowable, and we focus on the macro. We focus on the micro, which is the knowable: companies, industries, and securities. And if, this is a value conference, which is predicated on, I think, studying the micro. And if you read most value books or speak to Buffett and people like that, there's not a word about the macro. If you work really hard studying companies and industries and securities, I think you can get an edge that you can't get in trying to forecast economies and things like inflation and rates.
That sounds like great advice for our younger investors.
Yeah.
All investors.